Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Dave & Buster's stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a small cap company, 1.3 billion market cap. They're trading at $34 a share and they have 38 million shares outstanding. Dave & Buster's owns and operates entertainment and dining venues for adults and families in North America. They offer a large menu of appetizers, alcoholic and non-alcoholic drinks, various food items. They have many games at their establishment and live sports on the TV. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Free cash flow looked good in 22 and 23. It did come down a lot in 2024, only 34 million. Then negative in the trailing 12 months, negative 11 million. Net income is the profit or loss on the income statements, revenue minus expenses. That's around $100 million a year or in the low $100 million range. Pretty slim margins, 8% in 2022, half that in the trailing 12 months, 4%. Revenue is a sales for the company, and that does go up from 1.3 billion to 2.2 billion, down a little bit from 2024 to the trailing 12 months. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 2.4 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.8 billion. We divide that by 38 million shares. And we get a calculated stock price of $48. They're trading at $34, so they're trading at a 29% discount. It's a buy according to the model. Do you think it's a buy or sell? Let me know in the comments. Simply, Wall Street's price is 26. They say the stock is 21% overvalued. 7 analysts priced this stock at 62. So they say the stock could double in the next year. There are 42 companies in the same industry as Play, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend a good amount of CapEx, almost 400 million. These are the investments in property, plant, and equipment. They have a really high debt to equity ratio. For every dollar of equity, nearly $10 of debt. They have negative free cash flow. They rank 20th in market cap. Price to book is a little worse than the average. They're trading at 4.4 times book value. PE looks real good, 13, much better than the median average. We can't look at that price to free cash flow, negative free cash flow. Really good price of sales is below 1, which means their revenue is higher than their market cap. 2.2 billion of revenue, more than the median. And it looks like they're growing their revenue a lot. Their 5-year annual revenue growth rate is 11%. Here's their latest income statement, the 3 months ending 5/5/2024. Revenue is down a little bit. It was 597 million, now it's 588 million. Entertainment revenue is down, so is food and beverage revenue. The cost of entertainment is only 33 million, and they generated 385 million of revenue. The cost of food and beverage is 54 million, they generate 200 million of revenue. So their margins are much better in entertainment. Cost of revenue, 87 million, that is down from last year. Operating costs, 503 million, up from last year. Payroll is up over 10 million, and store operating expenses is also up 10 million. So operating income is down. It was 120 million, now it's 86 million. They spent 33 million of interest on their debt, higher than last year of 31 million. Net income 41 million, down from 70 million. So their EPS was $1.46, now it's $1.03. But they are buying back stock, that's a good thing. It was 48 million, now it's 40 million shares. So to summarize, I have them trading at a 29% discount, ranking 6 out of 10. It looks like it could double or triple in the next few years. But they operate in a really fierce industry. Lots of companies are going bankrupt in retail. Would I buy them 6 out of 10? It does seem like a good price point. Ratio is 5 out of 10. Really good PE. We can't look at their price to free cash flow. Financial is only 4 out of 10. Their revenue is up 68% from 2022, but their free cash flow is negative. So they need to turn that around. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking the link in the description below. Thanks for watching.